Ladies and gentlemen, good day and welcome to Trustline Holdings investor call for PMS Fund. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Arunagiri, Founder, CEO, and Chief Investment Officer. Thank you, and over to you, sir.
Thank you. So good evening, everyone. Thanks for joining this call on a weekday. Really appreciate that. As we step into 2024, we have some good news to share to all of you. This year, Trustline will be celebrating its 20th year anniversary. It's a great milestone for us, and it is 2 decades of value creation and research excellence by our team. In addition, we're also happy to share that we recently crossed a very crucial milestone in our assets under management. We crossed 1,000 crores of assets recently, out of which close to about 850 crore is from PMS business, and the balance about 210 to 15. 215 is from our AF business. All these achievements stand testimony to great support, trust, and confidence from our clients and investors like you. On behalf of the team, I take this opportunity to thank every one of you, all our investors, for being part of this passionate journey and for supporting us all through this journey. In terms of context for this call, as we have been highlighting in our earlier calls as well, the reason why we do this call is to primarily bring transparency to our investor communications. We do regularly send our newsletters, quarterly newsletters to all our clients. Some of you may have had an opportunity to have a look at it. The idea is to take it further from there and provide an opportunity for our investors to understand our views on the market, our portfolio highlights and portfolio actionables, and more importantly, how is our portfolio now structured, for the coming weeks and months in terms of performance. So that's the plan. In terms of the structure, it is like what we usually do. We start with our market view highlights and portfolio actionables, and then move on to Q&A. Overall, our plan is to wrap up this session in 45 minutes. First 15 to 20 minutes is on the market highlights and portfolio highlights, and the balance time we will dedicate for the Q&A. So that's the overall plan. So when we talk about the markets, there are many questions on investors' mind. There's been a one-way market since last April. It's been a one-way run, kind of a bull run. So a lot of questions in terms of many people are wondering whether this market is moving, going much ahead of its fundamentals. And does the fundamentals merit this kind of optimism? Will there be a correction? Is the correction going to be time correction or price correction? What will trigger the correction? How does one navigate if there is no correction in terms of this, navigating this expensive market? These are all questions on investors' minds. There are really, not easy. There are no easy answers for all these questions. We would like to respond in this forum to all these questions, but instead of, responding, looking at these questions individually and separately, what we thought is we'll look at some of the key trends that are likely to play out this year. And then probably investors can get the clues from these, trends in terms of the questions that are challenging, that are challenging them. So that's the idea. Of course, short-term predictions of market trends is fraught with usual risks. Short-term trends are a function of a lot of moving parts, interplay of too many macro variables. So it is very, very difficult to, predict how the markets will play out, or how the trends will play out in the short to medium term. And we seriously understand the folly of forecasting A lot of people have forecasted many things and, nothing, most of it hasn't played out. So with that caveat, we will venture to look at some of the key trends that will play out this year. So the first trend we are going to be looking at is the global interest rates, that is US interest rates, especially by US Fed. There are many questions on this front, whether the rates have already peaked. Are there going to be any, many cuts in this year, rate cuts? If rate cuts are going to be there, what kind of quantum? And if rate cuts are going to be there in this rate cutting cycle, where would they finally eventually settle in terms of final rates? So these are some of the questions we would like to explore. Now, in terms of rate cuts, of course, the chances for rate cuts have increased significantly post the Fed pivot in mid of December, post that press conference by the Fed chair. So the chance of rate cuts have increased. Now the market is forecasting at least 3 to 4 cuts in the second half of this year. What kind of quantum is difficult to guess, but where would it settle? There, I think we can go and find out from our past experience. In the last cycle, in the rate cutting cycle, the rates settled very close to zero, near zero. Will that happen again? Very difficult to say, but in our view, this time, given the unsustainable fiscal deficit in US and a very high US debt to GDP ratios, it's very difficult for the rates to go near zero. In our view, probably the rates would settle after the rate cuts somewhere close to 2.5 to 3%. One of the very seasoned investor, Howard Marks, in his recent memo, latest memo, had ventured to predict very specifically that the rates are unlikely to go down below 3.5%. So somewhere I think one needs to prepare for higher for longer kind of a rates. When he says 3.5%, he is also saying that it is going to be for next 5 to 10 years. Unlikely to go below 3.5 rates. That's a very long period. So one needs to prepare for a higher for longer kind of scenario. If that situation, in case if it plays out, then one needs to, be prepared for implications on FI flows in the emerging markets. Also, in terms of emerging market central banks will have limited room to cut rates because of the currency linkages. So this is one trend one needs to watch out. It's a very interesting trend, and as the year unfolds, one will have some clues to what exactly is going to happen on the interest rate front. The second trend we will look at very closely is China's coming back. Now, all of us know that China is in deep trouble, and their property cycle is in a slump. They are going through deflationary challenges. And Chinese markets, all of us know it's at 3-year low. Shanghai's index is at 3-year low. Hong Kong, in fact, their market indices, if you look at, they are very close to 2009 levels. And that's one of the reasons I think India has suddenly outscored to become a top 4 market cap globally. We were just behind Hong Kong. Now we have gone beyond Hong Kong marginally. So it keeps varying day to day. But that's one of the reasons. So given this kind of challenges, given this kind of situation where people are forecasting, gloomy scenarios for China, it may seem very absurd to talk about China's coming back. But in our view, at some point, all the bad news gets into the base, into the price, and the cycle starts reversing. Will that happen this year? We don't know. But if that happens this year, in terms of Chinese coming back, then there will be a serious risk for India, because India is one of the key beneficiaries of Chinese reallocation in terms of FIs rationalizing their allocation in terms of flows to India. Just to give you a data point, just 2 years back, Chinese weightage in MSCI used to be around 38-39%, and India used to be around 10%, less than 10%. Today, as we speak now, Chinese weightage in MSCI has come down all the way to 27-28%, and India has moved up to 17-18%. So, for some reason, this risk plays out in terms of China coming back. Then probably, I think, we need to be prepared for normalization for Indian markets. In my view, this is one of the serious risks for India in terms of flows and reallocation. And coming to the third trend, it's about India's macro. Of course, India's macro has been one of the shining spots for last 2 years, primarily because of very prudent macro management by this ruling regime in terms of fiscal prudence, in terms of current account deficit, in terms of exports, and in terms of forex reserves and currency management. The management of macro metrics is one of the key reasons. That is, macro stability is one of the key reasons for FIs pouring in a lot of money, even in a year when they had taken out money from other emerging markets. So, whether this kind of macro stability will continue for India this year, that's not such a difficult question. Now the markets have started discounting political stability and policy continuity for this year, especially after the outcome of the state assembly election. Now, if there is no surprise in the outcome of the general election, Lok Sabha election, then I think India macro will continue to be a bright spot for the global investors. Now, let me come to the last and very interesting trend, which is what a lot of investors are looking for, is what kind of dynamics will dictate the trend for stocks in India. This is very, very interesting because that gives you the real market outlook. In our view, there is going to be an interplay between flows and the valuation. So in a way, to put it other way, it is going to be a tussle between flows and valuation. On one side, you have very, very expensive valuation. All the market, the indices across the spectrum, be it large cap, mid cap, small cap, all of them are trading at a valuation which are at a premium to historical averages. On the other side, the flows doesn't seem to cease. And in fact, if you look at last year, DIIs, the domestic institutions, which includes basically banks, mutual funds and insurance companies, they had poured in about $21 billion in the calendar year 23. FIs had brought in close to another $20 billion. We are talking about a $40 billion flows in 2023. That's a huge sum. Now the estimates suggest that in 2024, domestic DII flows itself probably overshoot to close to $30 billion. And even if you add about $15 to $20 billion, which is a very conservative from FI's angle, we are talking about $50 billion coming into India, into a market which is already expensive, trading at a premium. So this is going to be a tussle between flows and valuation. So it's not going to be an easy market for investors. It's going to be a challenge for investors. So the best way to navigate this market is only through stock-specific bottom-up approach, because the trend, how it will play out, is very difficult to say, given the dynamics and the interplay of flows and valuation. So this is how we are seeing the trends for the market for the next year. So given these trends, our approach to how we action in these high momentum markets are threefold. Basically, use this strong rally to exit from weaker positions. Stock-specific pruning in high-weight allocations to raise cash level. We are looking at raising cash levels close to about 10-12%. If the markets continue to surge, leading to overshoot in our positions, especially ahead of results announcement or specific events in the underlying portfolio position. Stay on with quality positions even if the weights keep going up, given the strong medium-term outlook for the markets and attractive India story. So this is the broad actionables given all these trends. Thanks a lot once again, and next call will be 6 months down the line. We look forward to that. Thank you. Thank you for participating on the weekday. Once again, thank you.
Thank you. On behalf of Trustline Holdings, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.